Okay, so the next topic is goal-based planning. Now we all recall from behavioral finance that we studied what we called pyramiding. We studied that people actually put their money in baskets. Money is fungible, money is interchangeable. However, people put money on different spreadsheets and they classify money in different categories, risk-free versus risky. We also discussed in state planning the concept of core capital and also a safety reserve. So the core capital was the money that we needed to survive. We also discussed ruin probability. So this takes on from the pyramiding angle, and it brings the new concept of risk buckets. So essentially, risk buckets are also a way of allocating your assets. So it's a form of asset allocation. It's a bit sophisticated. And the risk buckets are broken down into three categories. The first category is personal risk. This is the risk of losing your home or become very poor. So from a client angle, he is incredibly conservative with regards to this portfolio, with this section. So this will house his home and his cash holdings. So all T-bill are parked here. The other part of the pyramid or the bucket is market risk, whereby he would want to maintain his current lifestyle. So it's a status quo. And in this category, he will put money in stocks and bonds. As you can see, that as we go down here, the risk profile actually goes up. The third category is aspirational risk. These are the wants as opposed to the needs. And what we are looking to do is to build on our current wealth spectrum. Okay? So we're moving onwards, and in this category we hold concentrated holdings and risky investments. Now let's go through example number 2 in the curriculum. This is a gentleman. Now Bill Wharton is Fred Garcia's financial advisor. Garcia is 60 years old and he's a CEO of an aircraft part business that he founded 30 years ago. For over a decade, Garcia's son, now he was expecting his son to take over the business, but at the last minute, his son wanted to do something else. So he's been very shocked by this new development. And now what he wants to do is to look at alternate options with regards to this portfolio. Now he currently owns a business that is worth $40 million. And he has investment real estate consisting of office building, warehouse and land. That is about another 5 million. He has 3 million of stocks. And he has bond portfolio. This is stocks and bonds. And then he has 1 million of cash. And an unmortgaged home of 1 million. Now he's asked Wharton what he thought of his current financial picture. So what's happened right now is that Wharton, what he's done is that he's classified his wealth and distributed in 3 buckets. So he's got a personal risk or the protective assets, which would include, what would this include? The home, the cash, anything else? That should be it. Okay, what about the market risk? What should this hold? Equities and fixed income. Okay, what about the aspirational assets? If you can see, aspirational risk bucket actually holds your concentrated holdings. So this bucket will have his family business, is that right? Yes. Which is $40 million, and the investment real estate, which is another $5 million. So that's the bucket. So his personal bucket is $2 million, market bucket is $3 million, and his aspirational bucket is $45 million. As you can see, there is a priority gap. There is a mismatch. Okay? Now, if he's looking to maintain his lifestyle or protecting from being poor, we have to see that is his current portfolio, excluding the concentrated holding, enough to do that or not? So the first question is, using a goal-based planning framework. A goal-based planning framework would include personal, market, and aspirational risk buckets. We need to identify the significant risks. So what are his risks? His total net worth is 50 million. Is that right? Okay. 2 million personal, 3 million market, and 45 million of aspirational. So out of this 50 million, 40 million is aspirational. Okay? 45 million, so that's 90%. 45. A 0 can be converted to a 5 easily. So 90% is actually in a concentrated asset, which is his business and commercial real estate. Okay? Now, at his age, would this sound like an irresponsible thing to do? Well, he's retiring. His son's not looking after the business anymore. He has to run it because he's not going to run it because he's going to retire and he will need to sell it. The first thing he needs to look at is diversification, right? So at his age, I mean, it's excessive risk, right? Somebody who is, how old is he? He's 60 years old and his son does not want to do the business anymore. So I think that should be the perspective here. Secondly, what should be the first step that he should do, that the advisor or the client should do under the goal-based planning framework, so that Wharton can help Garcia to determine whether he should sell it or should he monetize it. Now, can I have some views on what is the difference between an outright sale and monetizing? Okay, so if I technically borrow cash against my property, that would mean that I am not giving up control of the property, right? But I am actually getting cash for it. That is monetizing. We've all heard of the concept that your car will be monetized. The company will not give you a car, it will be monetized. So while the company will own the car, they will give you the money. That's it. Okay? So, now the first thing that they need to do is actually figure out the core capital. What are his spending needs? How much does he need for the foreseeable future? What are his post-retirement needs? And what does he need to do? He needs to eliminate the chance that Garcia one day will say that I don't have money, I'm broke. So he needs to avoid that. So Wharton's responsibility is to make sure that he calculates the primary capital that he needs to sustain his lifestyle and not run out of money. Okay? So the other point, the third question is very interesting. It's actually explain how this knowledge that the sale or monetization should meet Garcia's primary capital, and we will let to understand that $35 million is the primary capital. Okay? So how will this play a role in deciding whether he should sell or he should monetize? So this knowledge is important so that Garcia can know that if he sells his business, what will be the tax implications of selling the business? Or if he monetizes, what are the restrictions and what can he do with this particular asset? What will be the impact on the risk buckets? So if he sells, how does it play a role in making sure that his risk bucket is balanced or he monetizes? So you may be given a scenario in the exam whereby while you may not have to calculate the tax impact, but if numbers are given and you're asked to differentiate, you may have to do a calculation and actually decide which option should he go for. Okay? The next section is something that we have studied in reading 12, estate planning. We discussed asset location. While in the previous reading, in reading 12, what we meant by asset location was, should asset be kept in tax deferred or tax exempt or taxable? Here they further expanded by actually discussing, should this asset be kept or should this money be kept in stocks or bonds? How should you keep the assets? What should be, if the long-term capital gain on a particular asset class is different or higher or lower, that will determine, the taxation. So that's one angle. And the bottom line is that we need to pursue a tax efficient strategy so that we can make sure that we have a net of tax benefit or an alpha. The other angle is wealth transfer considerations. Now, we've discussed the generation skipping tax, whereby you can avoid tax by skipping entire generation. So instead of actually gifting property or transferring wealth to your son, you actually give it to your grandson. Okay. Now, in this case, they have these very interesting new additions actually, that you can actually shift early to avoid taxation related to the growth of the business. So if I gift the business, right, to my son, and this is a startup, when I gift it, this business, that is where the tax ends. So laws can stipulate that if this business grows further, the son will not incur any additional tax. Okay, this is a classic case of state tax freeze as well. There are mechanisms to do it. So let me elaborate further on this. So one way how you can avoid tax is that you can gift it to relatives. Okay, so at that point in time, the impact of the basis is eliminated. So that's it. So any growth related tax, they will not pay. So whatever tax you pay now based on current performance. The other angle is state tax freeze, which I will explain just now, and the other is long-term trusts. We discussed benefit of giving to charity tax. We discussed that when we put money into charity, what happens? 3 impacts to it. That the money in the charity can go tax free. The other thing was that there is no capital gains tax on it. And the third was that the charity contribution is tax deductible. Great. Okay. Now, how state tax freeze works is that the company is recapitalized to include preference shares. We all know that preference shares actually have a fixed amount of dividend that they get, and the valuation does not move, right? So it's the common stock that actually moves up and down. So if the preference shares are with the family, hence there will be no tax incidence. And how this works is that in the event that this person dies, and there's a lot of deaths in CFA, when somebody dies, then this preference share can be realized and then common stock has the tax incidence. So essentially, the family does not have to pay tax because they have the preference shares, but the shareholders don't lose value because the common stock is growing in price. That's the state tax freeze. That's how it works. We have a question. Okay, let me explain it again. State tax freeze, technically, look at the final point. This tax freeze freezes equity. So it will freeze the future growth for tax purposes. So this would mean that if the stock is worth 100 today, okay, and so you can technically freeze this as your basis. So if it becomes 5,000, you don't have to pay a tax on the remaining 4,900. This goes tax free. Okay? So the incumbent or the person who's going to receive this will not have to pay taxes. Okay? Now, let's look at example 3, John and Barbara Wilson. They live in a country that imposes a current gift tax of 40% on the transfer of any property that exceeds 10 million during their lifetime. So 10 million and above is taxed during lifetime. And they have already used this 10 million gift. So they've already used this exemption. So whatever they transfer now will have a tax impact, potentially. They own a business currently worth 10 million, but they believe that the business is poised for explosive growth that will begin shortly. So this is an emerging markets food business. Explosive growth of this business. The children are already involved in the business and they want to pass control of the business to the children, but at this point they feel that the children don't have the necessary expertise to run the business. So they would like to retain control. So they would like to transfer. So what is happening here? While they want to transfer the business to their children, they fear that if they transfer in an absolute arrangement and the children start running it, they will not be able to run it as good as they would. Story of our lives. Okay, so now what they want to do is that they would like the growth that is expected of the business to directly benefit their children. So they want the business to grow, the growth to benefit their children, and we have 3 questions. First question is, would a direct gift of the company stock from Wilsons to the children satisfy their objectives? If you gift, what is happening? You give them control of the company, which is something that they don't want right now, obviously. Okay. So, and what else?
Already used a tax sheet.
So they will have a
tax impact
of 40% on $10 million. Okay. So there are 2 reasons why they should not do it. Okay. The second question is, would a direct gift of the company stock from the Wilsons to a trust set up for the benefit of the children satisfy their objectives? Why not?
Because it's a tax.
So it's technically the same reason as solution 1 or the first answer. That there is a tax incidence which is going to be 40% when they sell or transfer. Now, what about a corporate estate tax freeze? What will this do? Like I mentioned, the estate tax freeze would recapitalize the company, number 1. Number 2, they will issue preference shares, but preference shares will go to the kids. That will not have any capital depreciation in them. So while the company will grow, the common stock is growing, but there's no tax impact. So I think that's the final point that we need to look at from this particular example. So be prepared that these, and let me reiterate that CFA states, the institute states, that examples are actually examinable material. So there is no escaping from doing these examples. How do we manage or diversify concentrated wealth? What's the decision making here? So that's a 5-stage process. The first thing that we do is, and we've discussed this, that we need to establish objectives. I need to look at constraints. The objective is, predominantly it will be how to get rid of this concentrated holding, and the constraint would be why we should not be doing it. Which would taxes, liquidity. This could be practical reasons, voting controls, this could be too early to sell this business, or there could be emotional or cognitive reasons for this. Okay. So the second stage is we identify tools and strategies, how we should be executing this particular strategy, rather identifying them. The third angle is evaluating what will be the tax event, what will be the tax incidence or the tax implication of each strategy. So you compare between strategies. The other would be to compare non-tax strategies. What are the other implications? And then you formulate and document the chosen strategy. So that essentially sums up, the strategy. This is not a one-by-one way to do it. There's a lot of feedback and looping, essentially. So if you get stuck at one point, there's a question, you go back and start all over again. So this is a dynamic process that you have to keep asking the right questions, like we discussed, while correcting cognitive biases. We have three broad techniques that we will be studying. First one is the easiest, that's an outright sell. The second one is monetizing, and the third is hedging. Okay? So what we'll start with, there are three, like we mentioned, there were three sections. The first section, or one section, was how to diversify from a public holding, concentrated holding. The other was how to diversify from a private business holding. And the third was how to diversify from a concentrated holding in real estate. So we'll do the real estate first. So essentially in real estate, you have three options. The first option is to mortgage. What happens when you mortgage? So you mortgage it to the financial institution and then you get cash. Is that right? Okay. And then if you default, what happens? The lender can take over your property. So essentially, doesn't it work like a put option? So you have a put option to default. So if you exercise a put option and you default, he will take away your real estate. That's a mortgage. The second example is a sale and leaseback. The sale and leaseback is done with a financial investor. What happens is that you have a business that has substantial needs. You want to utilize and monetize the real estate, but you don't want to lose control of the property because it's an integral part of your business. So you want to grow your business, section 5. You want to grow your business while managing the risk and not giving control. So when you give a lease, essentially when you sell and then you take out a lease, the lease expenses are tax deductible. That's the first benefit. The other thing is that when you get this cash, when you sell, it's technically distributable. So you can give it to your shareholders. You can put it in the business. You can give it out to somebody. Now, this also plays a role in a credit crunch where banks may not be willing to lend very actively. And then you have a tangible asset that is generating cash flows. So you monetize that particular asset. Okay? And when you do a sale and lease back, any debt associated with that property is settled. So your gearing, the business gearing, actually goes down. Okay? The third angle is the charitable transfers, and the charitable, section 6 actually, and charitable transfers, how the curriculum has actually explained this is that they have spoken about a donor advised fund. So technically what happens in a charitable transfer is that this is a tax elimination strategy. So if you want to make a charitable transfer, and you sell the asset or give the asset away to make a hospital, you will have a tax incidence. But if you give it to a charity, what happens is that you're giving it to a charity and that charity is not taxed. So that's the impact, essentially. So any capital appreciation on that property, you don't have to pay taxes on it because you've transferred there. And whatever you're contributing to charity is tax deductible, as we discussed in reading 11.